Good day, savvy investors, rookies, and pros alike. Welcome back to Investing Lighthouse, where we make financial navigation easy and exciting. You know, investing can be as thrilling as a theme park ride. You've got ups, downs, and the butterflies in your stomach. But let's remember one thing: safety. Just as you wouldn't get on a roller coaster without a seatbelt, you shouldn't dive into the investing pool without a margin of safety. So, buckle up, because today, we're unearthing the treasure that is the concept of margin of safety, taking it from the vaults of financial wisdom into the gleaming light of understanding. But who's the captain of this ship, you ask? It's the investing legends, Benjamin Graham and his star pupil, Warren Buffett. Graham introduced the margin of safety concept, and Buffett took it mainstream. Simply put, it's all about ensuring you have enough room for error when investing. You see, we can't predict the future. Not yet anyway, unless one of you has a time machine lying around. Here's the deal. We can only apply the margin of safety if we know a company's intrinsic value, the company's actual value based on its future cash-making capabilities. Think of it as attempting to purchase a Picasso without knowing a thing about art. To illustrate, let's journey with our hypothetical company, Cash Flow Mania. So, how do we figure out its intrinsic value? Here's where our leading man, discounted cash flow, or as the cool kids call it, DCF, comes into play. DCF gives us the present value of a company's expected future cash flows. Imagine you're getting all of a company's future profits in today's dollars. Pretty neat, huh? Because let's face it, $1 today is worth more than $1 tomorrow. But hold on a second, we're not just looking at any old cash flows here. We're talking free cash flows, the cash remaining after a company has covered its expenses, invested in its future, and still has money to spare for you, the shareholder. It can be used for dividends, share buybacks, debt repayments, or acquisitions. Calculating free cash flow might sound like solving a Rubik's Cube, blindfolded, but it's pretty straightforward. Take the cash flow from operations and subtract capital expenditures. Both these numbers can be found in the company's cash flow statement. It's like baking a cake. Instead of flour and eggs, you use numbers and a pinch of financial savvy. If our pretend company, Cash Flow Mania, has $25 million in cash from operations and $15 million in capital expenditures, its free cash flow would be $10 million. Now, we expect Cash Flow Mania to grow, so we'll assume their free cash flow will also increase. Let's predict a growth of 5% per year for 10 years. If Cash Flow Mania's free cash flow is $10 million at the start of year 1, with 5% annual growth, in the 10th year, it will become approximately $16.3 million. But if we get too enthusiastic and predict a growth rate of 25%, that 10th year's free cash flow projection suddenly becomes a whopping $93.1 million. That's like expecting a Chihuahua to grow into a Great Dane. That's why it's super crucial to be conservative with our estimates. Remember, optimism is excellent when rooting for your favorite sports team, but not so much when calculating future cash flows. Be like a detective, investigating past growth rates, industry trends, competitive position, etc. Future predictions can be as fickle as fashion trends. One season you're in, the next you're out. Once we have our future free cash flows, we must bring them back to today's value, using a discount rate. It's like reverse time travel for money. This is where the notion of time value of money shines. Essentially, $1 today is worth more than $1 in the future. Why? Because you have the opportunity to invest that dollar today and make it grow over time. A 10-year-old dollar isn't just older, it's also less valuable. To illustrate how this time travel can make a massive difference to the value of money, let's say our 10th year cash flow is $10 million. If we discount it back by a rate of 10%, it's worth about $3.85 million today. But if we look at that same cash flow, but 20 years out, it's only worth about $1.48 million today. The further the cash flow, the less it's worth now. Selecting an appropriate discount rate can feel like picking the perfect avocado at the supermarket. Too high and you undervalue the company. Too low and you overvalue it. It's a balancing act, like tightrope walking. To help you choose an appropriate discount rate, consider it the return you'd expect on the money if it was invested elsewhere with a similar risk profile. It's like the opportunity cost of a Netflix binge when you could be learning to play the guitar. Now, once you discounted each cash flow for each year and added them all up, you'll also need to discount the terminal value back to today. The terminal value represents all the future cash flows beyond your forecast period. Said otherwise, it is the amount you would expect to receive if you sold the entire company. Sum them all up and voila! You have the intrinsic value. Imagine you're at the end of a rainbow and just found your pot of gold. Comparing the intrinsic value to the company's stock price, you'll see if it's undervalued or overvalued. Is the stock price lower than the intrinsic value? Congratulations! You may have found a deal. But beware, intrinsic value is an estimate, not an exact figure. It can be as unpredictable as a cat on a hot tin roof. That's where the margin of safety comes in. It's like the extra buffer on a trampoline, keeping us safe if we bounce too close to the edge. If Cashflow Mania's intrinsic value is $100 per share and its stock is currently trading at $70, we have a 30% margin of safety. A more significant margin of safety gives you a buffer in case your assumptions were too optimistic. That's our cushion, our financial airbag. It means you're paying less for the stock, potentially increasing your return while reducing your risk as the stock price converges to its intrinsic value. But don't expect to find many Picassos selling for the price of a doodle. That's why patience is critical in investing. And there you have it, folks. A safe investing journey is all about knowing the value, having a cushion, and riding with style. If you found this journey as exciting as I have, tap that like button. And if you're eager for more, remember to hit that subscribe button and join our merry band of savvy investors. Let's navigate the financial seas together. The flag of knowledge held high, ready to conquer the waves and unearth more treasure. Be part of the discussion by commenting below and sharing your thoughts and insights. How are you going to apply the margin of safety? What company are you looking at next? We are here to engage, interact, and answer your queries. Remember, knowledge shared is knowledge doubled. So, let's grow together.